Very good afternoon, everyone. Myself, Naina Tyagi, Assistant Professor of IMT College of Management. Today, I am going to speak on the topic sources of finance, from where we can get finance and through which we can generate funds to invest in further projects. So, here are first slide, which is showing what are the different sources of finance, just like loan financing, project financing, loan syndication, book building, depositories, factoring, venture capital, credit rating, commercial paper, certificate of deposit, stock invest, the global depository receipts, loan financing. So first of all, we will get with the familiar with the term security finances. A security in financial context is a certificate or other financial instrument that has monetary value and can be traded. Securities are generally classified as either equity securities, which we can also call them equity shares, such as stocks, debt securities, just like debentures, bonds. The sale of securities to investors is one of the primary ways that publicly traded companies raise new capital for operations. We have already heard about the terms IPO, initial public offerings. They also offer the equity shares, or we can say that preference shares. From the very beginning, they start in getting finance through these sources. In United States, the Securities and Exchange Commission oversees security transactions, activities of financial professionals, and mutual fund trading to prevent fraud and intentional deceptions. Here we talked about the United States. If we talk about India, here is SEBI, Securities Exchange Board of India, which regulates the transactions of the stock exchanges. Now we will talk about loan financing. The finance which can be generated through long-term loan is known as loan financing. In common man language, we can say that if we go to the bank and avail some loan, get some money and paying interest, it is also called source of loan financing taken by industrial organization at the time of starting a new business or expanding their business activities. Generally, the loan financing period is from 5 to 10 years. In India, such loans are distributed by financial institutions like IDBI, ICICI, and IFCI banks. These institutions are specially set up for financial support and facility to industrial development. So our government provides such kinds of loan financing or promote our commercial banks to provide such loans to the our industrial sector so that our economy can develop and we can uh, promote our GDP level to increase up to the level to match the developing economy. It loan financing have following features. Long-term loans are fully secured. They have fixed rate of interest. If we talk about the loan, if we go to the banks to avail some loan, they want some security. If in any case the common man or the borrower fails to pay the ransom amount which he or the company have borrowed initially, then the bank will capture, or we can say that the bank will get that ransom amount by selling that particular security, or we can common language we can call it mortgage. They have fixed rate of interest. If the bank provides loans, so it charge interest and return on that particular amount. The borrowers have to return the loan in installments. It's up to the bank or the lending institutions terms and condition in which frequency they are getting their installments. The borrower has to furnish periodical financial statements, maintain a minimum working capital. If we go to the banks to avail some loan, first of all they want some projective financial statements so that they can see in future how you will get profits or how you going to pay their money. If they satisfied with your projective financial statement, then only they can provide you the loan. These types of loans are preferred as they carry a low rate of interest and thus lessening the burden over the company's resources. Now, project financing. Project finance is the long-term financing of infrastructure and industrial projects. These loans, or we can say these finances, are normally generated by the infrastructure or industrial companies. It is based upon projected cash flows, like future cash flows, which we estimates like we are going to generate these cash flows in the near future of the project rather than the balance sheet of the projected sponsors. Used for large infrastructural projects for high cost with large volume of funds such as power stations, fertilizer plants, satellites, oil, gas, and hotel projects. The financing is typically secured by all the project assets, including the revenue producing contracts. If these industrial projects or industrial or infrastructure companies fail to return the amount which they have borrowed from the lending institution, then all the assets attached to that particular project will be seized, or that lending institution will get their money by selling out these project assets. It is a risk management and risk sharing approach so that the owner or the sponsor exposure is limited. A project may be subject to a number of technical, environmental, economic, and political risks, particularly in developing countries and emerging markets. If the government and private players become partners, then the government can use funds belonging to others than their own for developing projects with limited liability for any shortfalls of cash required for payment of debt and equity holders. Loan syndication. The loan, which is provided by a group of lenders to a single borrower, is known as loan syndication. This loan is also called as participated loan. Here, the banks come in groups and then they will provide the loan to particular borrower. Borrower can be corporation, a large project, or government. Normally, and a common, the banks or lending institution will not provide loan syndication to the common men. These are particularly provided to heavy projects or to the government. There is a lead bank or underwriter of the loan, which is known as arranger, agent, and lead lender having more portion of the amount. Borrowers can directly make the loan application to a lead financial institution or approach merchant bank to arrange for loan syndication for him. Merchant banker undertakes the service of loan procurement and raising of loans from India and abroad. Now we will talk about the book building. This process is majorly comes under the share market. Book building is the process by which an underwriter attempts to determine at what price to offer an initial public offering based on demand from institutional investors. An underwriter builds a book by accepting orders from fund managers, indicating the number of shares they desire and the price they are willing to pay. Depositories. These are also the sources of finance. These are integral institutions in the Indian capital market and their functionality can be compared to banking entities. Their roles come into play from the time an investor makes a decision on investing. In India, there are two depositories, namely NSDL and CDSL. Here, NSDL stands for National Security Depository Limited and CDSL stands for Central Depository Services Limited that are registered with the SEBI. SEBI here means Securities and Exchange Board of India. It is a regulatory body or authority which controls the transaction taking place in the stock exchange. What are the basic functions of the depositories? Both NSDL and CDSL facilitate dematerialization of shares, that is, held the shares in the electronic form. So, in a way, depository is held accountable for safekeeping of your portfolio of securities. Here, hard copies of the share certificates or the share warrants are not to be maintained or not required to be maintained. Factoring. Factoring is a common term which is being used in the by the common men in the financial markets. Factoring is a type of finance in which a business would sell its accounts receivables to a third party to meet its short-term liquidity needs. Under the transaction between both the parties, the factor would pay the amount due on the invoices minus its commission or fees because it is providing the finance to the main lender. So he will that particular factor will charge a particular fixed percentage or commission or fees over that particular amount, which will be deducted from the main amount. Venture capital. Venture capital means funds made available for startup firms and small businesses with exceptional growth potential. Venture capital is money provided by professionals who, alongside management, invest in young, rapidly growing companies that have the potential to develop into significant economic contributions. It is a high risky venture. It finances high tech projects. The gestation period is long. The profit from venture capital investment will start accruing only after an average period of 4 to 5 years. Venture capitalist also makes available the managerial and marketing assistant. It is an active form of investment with a higher degree of involvement in the management of venture. When the assisted company has reached a certain stage of profitability, the venture capitalist sells his shares in the stock market at a hefty premium. Credit. A credit rating can be assigned to any entity that seeks to borrow money, an individual, corporation, state or provincial authority, or sovereign government. Credit assessment and evaluation for companies and government is generally done by credit rating agencies such as Standard and Poor's, Moody's, or Fitch. These rating agencies are paid by the entity that is seeking a credit rating for itself or for of its debt issues. What is commercial paper? Short-term unsecured promissory note issued by corporate and financial institution. It is issued at a discounted value. Fixed maturity period is 2 days to 270 days for a financing of accounts receivables, inventories, and meeting short-term liabilities. No collateral but needs high quality credit rating. It yields higher return comparatively to treasury bills. RBI regulates the commercial papers in India. The issuing company should have a tangible net worth of more than 4 crores as per the latest balance sheet. A CP has to be, here CP stands for commercial papers, has to be issued in multiples of 5 lakhs subject to minimum size of an issue to a single investor. It is a promissory note issued by a bank in form of a certificate entitling the bearer to receive interest. The certificate bears the maturity date, the fixed rate of interest, and the value. It can be issued in any denomination. It is highly liquid because in the need of investor, he can sell it in secondary market. It is negotiable. In India, certificate of deposit are issued by banks, either directly or through dealers. The minimum issue of CDs to single investor is rupees 10 lakh and can be further issued to multiple of 5 lakhs. Stock invest. Stocks are ownership interest in a part of a company. When you buy a stock in Walmart, Google, or Starbucks, you are becoming part owner of the business. This allows you to potentially receive profits that the company allocates to its owners. Those profits are dividends. A stock can also appreciate in value based on the success of the company. These are higher risk but have good long-term potential to make bigger profits. Global depository receipts. It is an instrument in which a company located in domestic country issues one or more of its shares or convertibles bonds outside the domestic company. In GDR, an overseas depository bank, that is, bank outside the domestic territory of the company, issues share of the company to residents outside the domestic territory. Such shares are in the form of depository receipts or certificate created by overseas the depository bank. Here is the mechanism of ADR or GDR. In India, issuing companies in India through lead managers, it is having some underlying assets and custodian or banking company situated in India, which has the physical possession of shares underlying GDRs and ADRs. If we talk about the overseas companies, then we are mandatory or we are obliged to have some overseas depositories which have some overseas investors, and overseas depositories here pays dividend to the overseas investors, and GDR is we are listing in European or US stock exchange. What is the basic mechanism of GDR? The domestic company enters into an agreement with the overseas depository bank for the purpose of issue of the GDR. Here took an example. If we talk about India and US, here India is a depositing company which enters into an agreement with the overseas depository bank, means we will enter into the agreement with the US depository bank for the purpose of issue of GDR. The overseas depository bank then enters into a custodian agreement with the domestic custodian of such company. So US depository bank will enter into an agreement with the Indian custodian of such company. The domestic custodian holds the equity shares of the company. So Indian custodian will hold the equity shares of the company, and on the instruction of the Indian custodian, the overseas depository bank issues share to the foreign investors. The whole process is carried out under the strict guidance of GDRs are usually denominated in US dollars. So we have become the familiar with the following terms, like what are the sources of finance, just like our loan financing, project financing, loan syndication, book building, depositories, factoring, venture capital. So in nutshell, we can say that through these various sources of finance, we can get the finance or we can generate the funds so that we can invest in further projects, generate some return, and have some profitability so that our company will grow and its wealth will maximize, which is the ultimate motive of the financial management. Thank you.